Let's bring back our friend Valley Bank CEO Ira Robbins. Ira, how's business?
Much better than what it was back in March. Wonderful to see you again, Tyler.
Yeah, that's good. Why don't you go sort of segment by segment? The one thing everybody seems to be worried about here is commercial real estate. What's your exposure there? It's mostly office buildings that seem to be attracting the greatest worry.
Yeah, it's a great question. I think, back in March, there was this fear that there was a systemic exposure across the entire mid-cap regional bank space. I think as you saw with earning results this year, strength and resiliency were two variables that came out of it. Deposits were strong for many of the regional banks such as ourselves. And I think when you look at credit, it really was a benign quarter for us. Valley has about $3.2 billion of office across our entire portfolio. We have $153,000 of non-accrual loans. That's it in the entire office portfolio. And I think there was this misnomer that there was a lot of commercial real estate exposure that sits in the regional base. You saw Wells Fargo put their reports out, 7.5% reserve on office. 60% of their non-accruals and commercial real estate are sitting in office. I think when people really dive in and look at the underlying metrics and 10Qs that the regional banks are putting out, I think you'll find a very different story than what's been promoted for the last couple of months.
I have a question, Ira, on this Basel III endgame that's being proposed. I understand it's an open comment period. Now, we were talking about it yesterday. Though you have to have more capital on hand to comply with this new regulation, what would you take it away from? Share buybacks, dividends?
Yeah, I think it's really just going to end up holding more capital, right? So you got to think about sort of how you think about your return on investments and what types of asset classes that you're in. I think the Fed and the other regulators need to be very careful about what they're doing here. When we think about what's happened since 2010, we've really taken a large segment of assets and taken them entirely out of the banking space. Look at private credit funds as an example, $300 billion of outstandings in 2010. $1.5 trillion are sitting in the shadow banking system today through private credit funds. Is this really where we want to put some of these specific assets? 30% of these credit funds are owned by public pension funds. So really what's happening is the Fed increases regulatory requirements on some of these banks. We're now saying these assets are far too risky for banks, and we're putting them in the public pension funds. Is that really what we want from a global market perspective? I think the Fed is knee-jerking reacting as to what they're doing when it comes to some of these capital ratios, and they need to think through some of the unintended consequences here.
Our question for you on loan growth. Where are you seeing the biggest loan growth in the last quarter, and where do you see that kind of going forward? And on the other side are they things that you didn't expect in terms of loan growth coming down in certain areas?
I think the consumers really slowed a lot of their loan growth down. We look at the auto portfolio, and we have a $1.8 billion auto portfolio across the whole Eastern Seaboard. That's really come down, I think, as where consumers look at interest rates. Inventories have increased a little bit across that space. So there really hasn't been much loan growth for us in the auto space. Residential mortgages have come down, really a function based on inventory across the entire environment. The refinance market's basically dead. So what we're seeing is a little bit of growth still in commercial real estate and a little bit in C&I. I think we did over 10% on the linked quarter in C&I. That said, our borrowers are very concerned about what interest rate environment is going to look like. So I think they're beginning individually to hold back their desire and ability to move forward on certain projects. So for us, we did about 10% loan growth annualized for this quarter, but our pipelines are about a third of where they were.